Okay, so you want to buy a bank. A bank is the only legal business in the world where the government lets you lend out money that isn't yours, multiply it roughly tenfold, and then insures your customers against the fact that you've done it. And it's also the business where Washington Mutual, $307 billion in assets, the seventh largest bank in America, went from too big to fail to seized by regulators over a single weekend. Same industry, same insurance, 48 hours from total collapse. Here's what you're actually buying. Tier 1. Buy a struggling community bank. Small banks with $20 to $50 million in assets change hands depending on health, sometimes near book value, sometimes below it after a rough year. Tier 2. Start one from scratch. A de novo bank. Regulators want $27 to $50 million in capital before they'll even talk to you. Enough to keep your Tier 1 leverage ratio above 8% of projected assets for 3 years. On top of that, roughly $14 million in setup costs, systems, branches, software, $200,000 plus in legal fees for the charter application, and $150,000 plus for consultants to write your business plan. Tier 3. Buy a real regional bank. Banks with $2 to $10 billion in assets currently sell for about 1.3 times tangible book value. $10 to $100 billion banks go for around 1.6 times, or 6 to 9 times earnings once you factor in cost savings. And just so the scale is clear, JP Morgan Chase, the largest U.S. bank, sits on close to $4 trillion in assets. No amount of personal wealth buys you into that tier. At that size, the bank is bigger than most countries' GDP, and it effectively becomes part of the financial system itself. Hidden costs nobody mentions, a compliance department that exists purely to satisfy regulators, core banking software licensing, FDIC insurance premiums, and a permanent capital cushion you can never fully touch. Before you touch a dollar, you need not one approval but 3. A charter from the OCC or your state regulator, deposit insurance from the FDIC, and often Federal Reserve membership. The FDIC requires your day one capital to equal at least 8% of what you project your assets will be 3 years out, meaning you're capitalizing a bank that doesn't exist yet, based on a forecast nobody can verify. Every officer and director gets background checked. Your business plan gets picked apart for years of projections. Even with regulatory easing, over 30 new bank charter applications were filed in 2025, and the process from application to opening still typically takes 1 to 2 years. And here's the catch buried in the fine print. Once you're approved, the FDIC only insures each depositor up to $250,000 per bank. Every dollar above that is an unsecured bet your customers are making on your bank's survival. A bet that, as we'll see, doesn't always pay off. Here's the trick. A bank doesn't lend out the money you deposit. It creates new money the moment it makes a loan. You deposit $1,000. The bank doesn't lock that in a vault. It counts it as a liability, and as long as it holds enough capital against the risk, it can lend out a multiple of it. With a classic 10% reserve requirement, that $1,000 could support roughly $9,000 in new loans rippling through the system, the money multiplier. Since March 2020, the Fed dropped reserve requirements to 0. Capital ratios, not reserves, are what constrain lending now. The profit is the spread, what the bank charges on loans minus what it pays on deposits, the net interest margin. Industry average, about 3.25%. Community banks, 3.46% to 3.77%, the highest level since 2018. On a $300 million balance sheet, a 3.5% margin is roughly $10.5 million a year, before a single loan defaults, and before you add in fee income from overdrafts, wire transfers, and card interchange, which for many community banks adds another meaningful slice on top. Here's the part that should terrify you. Banks borrow short and lend long. The money in your checking account can be withdrawn today. The 30-year mortgage the bank made with it doesn't get repaid for 3 decades. Banks bridge that gap with an accounting trick. Bonds and loans get classified as held to maturity, so the bank doesn't have to report losses on paper even when rising interest rates make those bonds worth less. The losses are real, they're just invisible until the bank is forced to sell. That's exactly what killed SVB. $209 billion in assets, $175.5 billion in deposits, 86.4% of them uninsured, well above that $250,000 FDIC ceiling. The moment depositors got nervous, they pulled $42 billion in a single day. SVB had to sell its held-to-maturity bonds at a loss to cover withdrawals, and the fiction collapsed. Solvent on Wednesday, seized by Friday. And then there's the safety net only the biggest banks get. Too big to fail. When Continental Illinois, a $40 billion bank, the seventh largest in the U.S., collapsed in 1984, the FDIC didn't let it fail. It injected $4.5 billion in capital and kept it running. Shareholders were wiped out, but the bank itself survived. That's the bailout playbook bigger banks have leaned on ever since. Failure number 1, Washington Mutual. $307 billion in assets, the largest bank failure in U.S. history. Seized by regulators in September 2008 and sold to JP Morgan for a fraction of its value. Failure number 2, Silicon Valley Bank. $209 billion in assets, the third largest failure ever, and the fastest. Solvent to seized in roughly 48 hours, March 2023. Failure number 3, First Republic Bank, just 8 weeks later. $229 billion in assets, the second largest bank failure in U.S. history, even bigger than SVB. Same playbook. Panic spreading from the SVB collapse triggered a bank run. The FDIC seized it on May 1, 2023, and sold it to JP Morgan in a fire sale that cost the deposit insurance fund roughly $13 billion. Failure number 4, Continental Illinois, 1984. $40 billion in assets, the original too big to fail, a government-funded rescue, shareholders wiped out, the bank itself eventually absorbed into what's now Bank of America. Success. Warren Buffett, August 2011. Bank of America was trading near $7 a share, fresh off the financial crisis, with investors fearing it would need a bailout. Berkshire Hathaway put in $5 billion for preferred stock paying a 6% dividend, $300 million a year just for showing up, plus warrants to buy 700 million shares at $7.14 each. When B of A recovered, those warrants turned into one of Berkshire's most lucrative trades ever. Optimistic scenario. You raise $30 million, get your charter, and after 3 years you've grown to $300 million in assets through deposits and loans. At a 3.5% net interest margin, that's $10.5 million in interest income. Subtract operating costs, compliance, branches, staff, roughly 2% of assets or $6 million, and modest loan losses, and you're left with maybe $3 to $4 million a year. On $30 million in capital, that's a 10 to 13% return, with payback in 7 to 10 years if nothing goes wrong. Realistic scenario. Regulatory approval alone eats 1 to 2 years before you earn a dollar. Most de novo banks lose money for their first 3 years. Real-world community bank ROE often lands closer to 8 to 10%. And none of that math protects you from a bank run, as SVB and First Republic proved twice in 8 weeks. A bank that's solvent on its balance sheet can be insolvent in cash within 48 hours, and your equity goes to zero regardless of what the spreadsheet said last quarter. So here's the punchline. A bank is the only business where the government lets you lend out money you don't have, multiply it tenfold, and insure your customers against the fact that you've done exactly that. For most of history, that arrangement made banking one of the most reliable ways to turn $30 million into a steady 10% a year, forever. But the entire system runs on one assumption, that everyone won't ask for their money back at the same time. When that assumption breaks, as it did for Washington Mutual, Continental Illinois, Silicon Valley Bank, and First Republic, the math doesn't matter. The capital ratios don't matter. The bank is gone before regulators finish their coffee. Meanwhile, an index fund investor with the same $30 million gets a similar long-run return. No charter, no regulators, no bank run, and nobody can seize their account over a weekend.